So I'm saying over the next few years, it's going to take them a little while to get their direct to consumer flowing here. I'm going to give them 3 years where EBITDA margins are going to be kind of brutal for them. Welcome back in YouTube. Today we're going to talk about Paramount Pictures. This is another streaming company that has been getting pretty much hammered over the last few weeks. Beat earnings recently, but market did not like it. We're going to dive through the quarterly report. I'm going to give you guys what I think a fair market value is for the stock. So let's get into it. By the way, if you are new to the channel, welcome in, consider subscribing and smash that thumbs up. We try to have a process on this channel to figure out what fair market value is for certain stocks. And today I specifically want to talk about Paramount Pictures. Now, this is one that obviously we all know from the new sequel that came out of Top Gun Maverick, and it exploded in the box office. So we're going to get into the valuation of this company. So right off the bat, we can see here that it's basically sold off from $40 all the way down to $24 recently. It looks to be maybe finding a bottom here. Not 100% sure on that. We'd have to do some charting on that. Oddly enough, with the success of Top Gun and some of the other movies that are coming out with Paramount Pictures, their PE ratio is down to 4. They do pay a pretty nice dividend of almost 4%. And Yahoo has them undervalued by roughly 27%. This company only has a $15 billion market cap. When we compare that to a company like Netflix, it is trading at a 20 PE ratio and has a $100 billion market cap. Or possibly a company that is a little bit more comparable is going to be Warner Brothers Discovery. This has a $35 billion market cap and almost a 7 PE ratio. Does not pay a dividend, neither does Netflix. Does not pay a dividend either. So as we can see here, there could be some underlying value here with Paramount Pictures. Trading at historically low valuations here, we can see that it, as recently as 2021, had a 10 to roughly an 8 to 10 PE ratio, and now, as we stated before, is trading right around a 4. Forward PE on the company sitting right around 10, which is about in line historically. When we look at analyst expectations, for Yahoo, they have them actually negative 6% revenue growth over the next 5 years. The company is growing slightly, and we're going to go over that here in a minute. So, I don't agree with this negative 6%. And when we go to stock analysis, we have as high as a $71 stock and as low as a $20 stock. They have them growing slightly, roughly 9% and 5%. Personally, guys, I think, 2 to 3% revenue growth for the company is very doable over the next few years. So that's roughly what I'm going to use. So basically kind of meeting in the middle between Yahoo and stock analysis. And looking at their recent quarterly report, to me, it seems they're on pace to do pretty well. A couple different aspects to their business here. First, let's take a look at top line revenue growth. Top line revenue growth year over year has grown 19%. Now that is pretty big growth here, guys. Direct to consumer only grew 1%. In the 6 months, it's down 3%, but we're going to go over why that direct to consumer numbers are why the direct consumer numbers are a little rough right now. So even with the nice top line revenue growth, we bring it down to bottom line operating income, and we can see down here it is down 33%. And when we take it to an earnings per share, which is most important as a shareholder, we only get 53 cents versus $1.50 from last year. So we can see across the board that earnings per shares are coming down, and we're going to go over that here in a minute. So when we break it down, we see that they're spending double to get direct to consumer. They are growing that business out, but it's costing a lot of money. The nice thing is they're still positive earnings per share. They're still bringing in positive earnings per share, even with the amount of spending that's taking place. So I do like that. It might be a short-term headwind with the amount of spending they're doing for direct to consumer, but a long-term benefit for shareholders, in my opinion. Ad revenue is coming down, and Paramount is no different. So a couple concerns in the short term here. We have advertisement revenue coming down, expenses are going up, still getting positive earnings per share. But as we can see, this is why the stock is selling off, as earnings per share are coming down. if the spending is going in the right direction and they get a positive outcome from it, long term, it will grow earnings per share, and it should grow their going direct to consumer should grow their margins as well, which means more free cash flow for the company down the road. So just a quick peek at assets here. They have about $4 billion in cash. That's down that's roughly down $2 billion from last year. But as we can see here, long-term debt is coming down. So that's nice to see. So they were at 17.6 billion long-term debt. They're down 2 billion roughly on long-term debt. So to me, that's a net positive, guys. They lost 2 billion in cash, but they lost 2 billion in long-term debt as well. With these streaming companies, the one thing I'm starting to notice is there is a lot of debt on a lot of the balance sheets. Definitely when you look at a company like Warner Brothers Discovery is another balance sheet that has a lot of debt on there. Let's talk really quick about direct-to-consumer here, as globally direct-to-consumer rose to 64 million people on the platform, which reflects 5.2 million subscribers and a removal of almost 4 million subscribers from Russia. So we're dealing with this huge transition where their expenses are going up, they're spending to get direct to consumer. Along with that, they took a pretty big hit, losing a substantial amount of subscribers here in Russia, and they're still adding subscribers. So they're in this weird inflection point here. Lots of spending going into direct to consumer, lost some people with Russia, but gaining some on the back end as well. So pretty much a flat growth quarter when we talk about subscribers. Could have been much stronger if the impact of Russia wasn't involved. So this quarter would have looked a lot different, in my opinion, if it wasn't for the 3.9 million subscribers lost in Russia. Then back down to, and then 1% from year 1 through 10. Okay, so basically I'm saying that there's going to be very, very low growth with the company overall. When you talk about 64 million subscribers in that compounding, with the movie business being so up and down, there's going to be years where they have blockbusters. There's going to be years where they have busts. So to me, it's going to even out, and I just don't see tremendous amounts of growth. Now, they could absolutely surprise, give double-digit growth, and then you're sitting on a huge opportunity here. But I'm being very, very cautious in my analysis here, as we saw with Yahoo, they think that they're going to do right around negative 6% average growth rate over the next 5 years, where stock analysis was between 5 to 6%. So I'm going to meet somewhere in the middle and say for the next 1 to 3 years, they're going to have about 2% revenue growth. From 3 through 6, they're going to have about 3% revenue growth. And then from 6 through 10, 1% revenue growth. As far as EBITDA margins go, right now, EBITDA margins are hurting a little bit as there's a lot of capital expenditures going into the business. This is a company that has EBITDA margins all over the place, so very hard to predict depending on what movies do well versus how much they're spending in the movies. So the EBITDA margins in this type of business is very unpredictable. But what I can tell you is it seems that double-digit EBITDA margins seems pretty reasonable to put on this company. Recently, with the amount of spending they're doing, EBITDA margins have come down. So I'm going to use 7% over the next 1 to 3 years, stating that they're going to be spending a lot of money, a lot of CapEx here. 3 through 6, I'm expecting them to expand back to double-digit EBITDA margins. And then years from 6 through 10, I got them going right around 18% EBITDA margins, which is roughly one of their better years when I looked back in history. Between 18 to 22% are some of the EBITDA margins that I've seen. So I'm going to use that as kind of long-term EBITDA margin opportunity for the company. We are going to add some shares to the company. They have been putting a decent amount of shares on the market, so I'm going to use roughly 4%. Share growth is the fact that it went from 615 to 617 all the way up to 649 in the recent report. That's a pretty substantial jump, so I'm building some protection in dilution from the company. Balance sheet right now has roughly $4 billion in cash and 18 billion in debt. The nice thing is debt has been coming down, so that's good to see. Definitely more of a high risk type of balance sheet when I look at this with the cash position, the amount of free cash flow that comes out of the company, and the amount of debt that they're carrying. To me, is a fairly higher risk type balance sheet. I wouldn't say it's awful, but I wouldn't say it's the best. So one of the red flags I would say is that recently they're spending a lot on CapEx. Margins are shrinking. Debt is fairly high to cash flow and cash position. So these are some negatives that I'm seeing with the company. When they're doing roughly 1% revenue growth, I have them doing right around 34.1 billion in revenue. And at that point in time, if share dilution is still going on, I have them having roughly 900 million, a little over 900 million shares on the market at that point in time. Their cash position slightly growing and debt coming down slightly as well. So once again, when we look at valuation of the company, it's fairly undervalued compared to its peers. So when we look at an EV to EBITDA of 8.7 versus the peers of 10, I feel comfortable using a multiple of 8 to 9 for this company. So if we use an 8 times multiplier for Paramount, I get a fair price target of $24.48, which would make it a buy roughly today. And I'm only putting a 10% rate of return that I'm looking for in the company due to the fact that right now it's paying almost a 4% dividend. So if you compound the 10% annual growth along with a compounding rate of a 4% dividend, you're getting a rate of return of roughly 14% year over year. So being able to buy the stock under $24 seems like a very, very good opportunity long term. Now, with that being said, ladies and gentlemen, I want you to understand there's a lot of risk with this company and a lot of risk with a lot of the streaming companies, as I do believe their balance sheets are not quite, the balance sheets are not really class A type of balance sheets. With that being said, I really look at Paramount as being an acquisition for a major company here. You're talking about a market cap of 15 billion for the company today that spits off roughly 30 billion in revenue and spits off close to $1 billion in free cash flow, has a decent balance sheet, and has a tremendous brand with a pretty extensive library. So I look at this company as almost an acquisition type of company for maybe a Disney and or a Netflix could possibly buy up a company like this for 30 to 40 billion dollars and really add an extensive library. I think we're going to see the streaming world consolidate, and this one to me looks pretty interesting long term. If I were one of the major players in the streaming world, Paramount Pictures to me is an interesting one, especially if I was a company like Netflix. Netflix doesn't have that box office presence. This acquisition would give them that box office presence. So interesting dynamic here, as I do think this is a company that could be a buy today. Now, this is not a recommendation to buy or sell stocks, guys. This is just me doing my due diligence, but you have to do your own. Now, if we put a 9 times multiplier on Paramount Pictures, we get a $28 price target and a $48 to $50 future value of the company. So as we can see here, might be some value. Obviously, do your due diligence. But this was my dive into Paramount Pictures. In my opinion, I find this one to be pretty interesting overall. I don't think there's that much more downside, but who knows? We could have a market crash and it could get cheaper. But for me, it's at an interesting point here where the company is growing. They are dealing with some turmoil here with Russia losing some subscribers, and they're spending a lot, but they do have a decent balance sheet compared to its peers, and it's undervalued right now, in my opinion, when you compare it to its peers once again. Just my opinion, guys. Hopefully you enjoyed my dive into Paramount Pictures. As always, appreciate your time. Thank you so much for spending it with me, and we will see you next time, investors. Peace.